Good morning, everyone. Welcome to my live stream. It is Wednesday, December 18th, and we've had a pullback in stocks. If you look at the Dow, especially, uh, the Dow has been pulling back, and stocks in, I think, traditional industries have really had a tough time. The rally has been really concentrated, as I'll show in a bit. And really, that's been the story for the last 2 years. Certain stocks have been just really flourishing, while the rest of the market is either just doing okay or really not doing well at all. So I'll show a couple patterns there a little later. The market is really waiting for the Federal Reserve to make a few decisions today. Probably made the decision. They're going to announce it at 9 a.m. Eastern, 12 p.m. Pacific. They're going to make a decision on interest rates. And if it's expected, they're going to reduce interest rates by about 0.25% and bring it down to 4.5%. That will, it's expected that interest rates will continue to gradually go down, but they haven't been doing so. And I'll show some of the data in that area, which has been interesting. The whole talk of interest rates are going to come down, that's been an expectation, but it hasn't really been showing up in the bond market. And remember that the Federal Reserve, they changed the borrowing rates between banks, but they don't have direct control of interest rates. The bond market, which is a market-driven level, that's what sets interest rates. And I'll show the bond market in a bit. While we're talking about data, tomorrow we're going to see GDP announced. And this, I think, could move the market. It could really move the market downward. A couple of things. So GDP is supposed to be 2.8%, was previously 3%. 2.8% isn't great and it isn't terrible. It's right in between. It's just okay. That type of growth, I think, will help with the whole inflation troubles we've had over the last couple of years. It's going to, if we don't have an overheated economy, I don't think inflation will be overheated as well. Initial jobless claims, this number can move the market. I think the initial jobless claims have been quite manageable, but if this number comes in higher than expected, that could really send a lot of fear through the market. We could see the market really move. Initial jobless claims, same story there. This is the number that I expect could really move the market, is the jobless claims. If we see more people unemployed and job losses, that really is going to show that the economy isn't doing great. And maybe 2025, 2026, the economy is going to slow down. So we'll see what happens there. Now, this economic data is going to move interest rates. But let me refresh my screen to make sure I'm seeing the most reasonable data. We can see that in the short term, rates have been coming down, which is good. And over the long haul, rates are still staying up. When you look at like mortgages to buy a house, they tend to look at the 10-year, and that rate keeps going up. Now, the positive thing there is real estate's really expensive. And if you have higher interest rates, I think it's going to put pressure on prices to bring prices down, which I think is a positive. But the whole narrative that, hey, interest rates are going to go down, yeah, they're going to go down over time, but they just haven't been going down very quickly. I'm going to look at the 5-year and show you that we're actually pretty much near the top that we've seen over the last 5 years. If you look at, we are here at the 5-year, and we've had a really run up of interest rates. We back in 2021, interest rates were incredibly low. Look how low they were, below 1%. It was just pretty much free money. And now we're way up here, just a huge increase in interest rates, and we are really near the top. So the whole interest rate story is, you hear words come out of everybody's mouth that, oh, yeah, interest rates are going to drop. But the facts are that interest rates have stayed high. And I'm seeing that downward pressure on real estate. I think this is also makes it harder for businesses to issue out bonds because they have to issue out bonds at a higher interest rate, makes it more expensive to take on debt. And that could be a limiting factor in economic growth for the economy. We'll see how things play out. I'm expecting that at some point we're going to see the 5-year go from 4.24 down to like 3.5. That would be a big move. And it would be better for stocks because if you have lower interest rates, you're going to have lower discount rates, which is going to increase the valuations of stocks. So that's what's going on economically. Now let's take a look at the stock market. So we are opening up. The Dow has had really tough time. We've seen the Dow really give up a lot of value over the last month, and especially the last 5 days. It's down 1.32. Today it's having a good day, up 0.31. But these are 30 big companies, and one of the companies is NVIDIA. It's interesting that NVIDIA has had a lowering of stock prices. The S&P is up just slightly. It's been doing just fine. The NASDAQ is up slightly. The Russell is up nicely at 0.59. I think small caps have really begun to perform great in 2024, and I expect the right small caps will continue to perform in 2025. Looks like Doomy Trash is in. Very nice to see you. Thanks for joining. I hope you're having a good morning. I hope your stocks are up. So that's the Dow. We're seeing a good day. It's kind of a modest gaining day, but at the rate that the Dow is going down, I think it's positive news to see that, hey, we're not going to go down anymore on the Dow. All right, so we've gone over economic data. Now let me show you a little more information around the stock market. So the S&P, and this has been the story for a couple of years, so it shouldn't be like, man, this is this is new. No, it's pretty much kind of certain stocks are getting a lot of attention and a lot of investment, a lot of inflows. The winner for the past 2 weeks has been Broadcom. Broadcom's received a lot of investment, and it represents 0.8% of the overall S&P rise over the last 2 weeks. Tesla has just been on fire. The whole story around Elon Musk having a very close relationship with the president-elect. Yep, that makes sense. Amazon's been going up nicely. A couple months ago, I shared with you that I was a big buyer of Amazon. I accelerated my buying. I'm glad I did so because Amazon's been performing well. This one, Apple just doesn't make any sense to me. They just don't grow their revenue, but it's a very comfortable stock. It's almost like comfort foods, right? They may not be the best thing for us to eat, but man, it's very easy to make it. It's very easy to kick back on the couch and eat those comfort foods. Apple is that comfort stock. Everybody buys it, except for me. I'm not an Apple believer, and I'm not buying Apple. Microsoft's had a nice 2-week run, and then Google's had a nice run, 0.6% of the overall rise in the S&P. And Google has had a couple of really positive stories. I'm a big Google stockholder, so I'm glad it's gone up. The biggest stories, the big story that is very real is Robotaxi. They're the leader. And I think that when I value the stock, you're getting the Robotaxi business for free. You're also getting the Gemini AI business for free. It's not in the numbers, is my point. And last is the whole story around quantum computing. So Google, the reason I own Google is for pretty much that this is one of the most, advanced, smartest, most capable companies on the planet. They started building their own AI chip 10 years ago, and now they're competing against NVIDIA with their AI chip to build out in their data center. And then last, Meta. And Meta's just been doing great for 2 years, and they continue to rise nicely. Now, this chart here, everything else, so these are 6, 7 stocks out of the S&P. The rest, the other 493 stocks are down 2.9%. And that's where you're seeing, the favorites in the stock market are getting a lot of the inflows, and everything else, you got to be smart about picking the right stocks. Makes it, I don't know if it makes it easier or harder. I own these two, no, actually 3, Amazon, Google, Meta. Those are the ones that I really believe in. But boy, if you just put all your money in these, you'd be very happy. That's not what I'm doing, but that's a reality. The other thing that we've seen that probably aligns with the graph I just saw, and Genetics Smite, thanks for joining. I'm going to get to your questions in a bit once I finish my stream of thought here. And Mike, thanks for joining. I'll get to your question in a bit. So materials, healthcare, energy, these guys have just been selling off. Here is materials. Here is healthcare. Boy, healthcare has just gotten beaten up over the last month. And then energy. Energy, there's no story that's telling us, hey, oil prices are going up or energy costs are going to go up. And those things are just realities, right? I'm seeing it in my stocks. I'm seeing it in my Chevron, my single material stock, then the healthcare stocks. But I'm going to get deeper into healthcare because I think that in the near term, the stock market is a voting machine. What is cool and sensational? Broadcom. In the long term, it's a weighing machine. Where are there companies that are making really high rates of profits, really high rates of free cash flow? They have great balance sheets, and they have very good earnings. And you weigh that value, and that's where I invest. I'm okay investing in boring stocks that make lots of money. I'm cool with that. And I think there's opportunity, especially in healthcare. Energy is a little bit tougher because we have commodities to deal with there, but there might be some value in energy. And then materials, I'm going to slowly get out of materials. I just don't have enough specialization and knowledge there to feel like I'm making great decisions. So I own one stock there, TX, and I'm gradually getting out of that stock. We'll probably not get back into materials, but I will definitely stay in healthcare and energy because I do feel like I do understand those industries, those sectors, and will continue to invest. But that's a reality check. I mean, this is not new. I know on the Discord, we've been going back and forth on how healthcare stocks are just getting hammered. They've just had a terrible month, and I'll get into that in a bit. All right, so those are some kind of opening comments. Now let's get into a couple stocks. Before I do so, let me go over the questions that are out there. If you guys want to talk about a stock, talk about a topic, please put it in the chat. We will go over it. So Mike, the dividend investor guy, what's going on, Mike? Very good to see your comment. Your thoughts on ZS? You're looking for a long-term hold. ZS. I'll take a look at. I'm not sure what company that is. Looking forward to seeing it. Genetics Smite. Hey, thanks for tuning in, man. I appreciate you watching the videos and I appreciate you tuning in. Please ask questions, and I appreciate you being a participant. So do I ever take into account suspicious insider trades into your strategy? Yeah, so quickly, I don't focus a whole lot on insider buying and selling, with a few exceptions, right? If there's excessive selling or excessive buying, that would catch my attention and give me one more data point to either be a buyer or seller in a stock or be comfortable with a stock. But it's not one of the principal, um, metrics that I look at. I tend to have kind of a recipe for success, and I try to keep that recipe simple, and I try to keep that recipe consistent. And if you watch my videos, you know what that is, right? I focus on free cash flow. I focus on the balance sheet, earnings, and I really like high margin companies, high margin percentage companies. So thanks for the question. And it looks like Zscaler is ZS. That's a good one to look at. I really like software companies, and security is always an important area to look at within software. Glad to look at that one. All right, cool. So we got through the comments. Let's jump into Zscaler. Wow, Zscaler is down 3.41% over the 1 year. It's down 12.65%. Over the 1 month, down 3.83. Okay. Wow, look at that. 5-year up 316%. Market cap is reasonable. The revenue, they're a little bit on the low side, 2.3 billion. Forward P is 63. It's a buy according to analysts. Let's take a look at their financials and see high level if it's a company that's really desirable. So first green flag is this revenue growth is very desirable. This shows that customers are buying more of their products and more customers are becoming customers. So very good job. It is slowing down a bit because part of it is just, the arithmetic on bigger numbers. It's just harder to maintain the same percentage as you get bigger because you have to keep growing and compare to a bigger number that you did a year previous. Now, so the growth I really like. Now, let's take a look at their gross margins. I'm expecting it's going to be very high because it's a software company, 78%. Really like 78%. So that's 2 green flags. They are a free cash flow company at 717 million, looking at the trailing 12 months. Now, based on a 30% growth rate and a 78% gross margin, I'm happy to take this times about 30. Just high level, is this worth kind of looking at the fundamentals closer, or I should say the valuation? And I get to about, call it 23 billion, maybe 24. So it's within that range. If I can get to 23, 24, assuming the balance sheet's good. Let's see here. So they have EBITDA. They're not producing positive EBITDA yet. They have more cash than they do debt. So their balance sheet's good. So they have their ability to pay off debt. Let's take a look at that free cash flow statement just before I stop looking at this stock. So free cash flow, I like this growth, really consistent. And the growth rate in free cash is really good, but I don't know that it's 45%. Yeah, it is. Okay. That's a very high growth rate on cash. So, this is a stock. I don't currently own a security stock. I like software companies. I really like software companies. And this one is a good one. I'm going to look at it more closely, Mike, because I like the idea of owning a software company that does security. And I'm going to analyze it more closely for the time being. And heck, if you guys won't mind, I don't see any other questions. Let's kind of jump into a valuation of this company and just go all the way. So this is Zscaler. I'll get into my valuation. Now, I look at a couple of companies that are really expensive, like Palo Alto and CrowdStrike, right? Of course, CrowdStrike was in the news for the wrong reasons earlier in the year. All right, so we've got these guys, CrowdStrike, and the reason I'm starting with CrowdStrike is I tend to like to compare companies that are similar, and Zscaler and CrowdStrike are similar. I'll make some room here in my Google sheet where I have my model. So this is a smaller company. They have plenty of cash, and I'm going to go with an 8% discount rate. I went with a higher discount rate with CrowdStrike because they had so many problems. I mean, they brought some big businesses down, and they were going to have some big lawsuits coming up, which they're trying to get through the Delta one. And looks like they may be CrowdStrike is probably going to get out of that, but we'll see. All right, so I'm going to look at their fundamentals on one screen and then just type them in, on the screen that you guys can see. So let's go ahead and move that over here, and I can start typing in all the fundamental data. Okay, so first, 8% discount rate. It says a company with more cash than they do debt, so I'm good with 8%. Their growth rate's really good at 30%. 20% growth rate on free cash flow. It was growing much faster, so I'm going to go a little bit better than that. I'm going to go to 25% and then 5% long term. I like to be a little conservative. It's probably they may do better than that, and that's all right. I'd rather be wrong and say, oh, the company is worth even more than I expected. But it's not a good idea to be overly optimistic and then buy into a company that isn't worth as much as I thought. So, all right. So here we are at 717 million. We're going to multiply that times 1.25. So that's our starting point. So the intrinsic value of the cash flows, if I grow them at 25% for the first 4 years, and then I grow 5 years after that, security software is here to stay. We need it. And the cash on the balance sheet, let's take a look at what we got there. So we've got 2,710,000,000 in cash. We have debt of 1,240,000. The market cap for Zscaler is 29,730,000,000. Shares outstanding 153 million. Okay, so each share is worth really around $300 a share, and it's currently priced at around $200 a share. So there's a nice discount if we look at the free cash flows. Now, when we look at the earnings per share, I look at the next year because I want to look at 1 year into the future. It looks like their earnings per share for a fiscal year 2025 is expected to be $2.98. It's also expected to be growing quite nicely each year after that. And I'm going to say that it's going to grow at around 20%. So based on earnings per share, it's not quite getting me to that stock price. And I might be a little conservative. Other analysts are saying it's going to grow better. But as you can see, I put more weight in free cash flow because this is the real measure of a company's value. So the stock is actually discounted at 29%. When we look at what analysts have to say about this stock, they believe that the stock is discounted at 16%. So I'm right there with them. My combined valuation, I've got a nice discount on the stock. Now, I like the software space. It just continues to expand, and you can see that the growth rate on Zscaler is there. They're doing 78% margins. That's excellent. You look at other industries, they are battling to get to 20, 30%. So I really like software companies. And this one looks really good. I think I'm going to take a closer look. and think about buying into Zscaler. Today it's pulling back. I wonder why. Is there negative stories out there? Yeah, I'm not seeing any big story that tells me, hey, that stock's kind of bleeding and I should get out of it. But let me look at it from a different perspective. I'm going to look at Zscaler and I'm going to compare it to CrowdStrike and Palo Alto. So these stocks are kind of moving together today. Let's look at the year. So, CrowdStrike was kind of like going away from the others and then it came back down. Palo Alto's been doing well, but Zscaler, for some reason, early in the year, they were kind of like trading together, and Zscaler, even to this point, has kind of lagged. What it doesn't make sense is Zscaler's growth has been really good. So what gives? Is it just the least known name? Like Zscaler isn't as well known. Well, as we've seen, the small caps are getting it done. If we look at the Russell, open this in a new tab. The Russell over the past year has been doing well, and especially um, post, I guess, the summertime, we're seeing a really nice rise in the Russell. So if you pick the right smaller cap stocks, they do really well. And you know, 29 billion, I guess 5 years ago, that was not a small cap. That was probably considered a large cap. But now that you have multiple above $1 trillion valuations, I happen to think that, Zscaler is probably now a small cap. They're probably in that Russell 2000. So the Russell 2000 is doing well. So, hey, Zscaler is not looking bad. It's looking like it's discounted, unappreciated. CrowdStrike still is getting a pretty high valuation. Palo Alto is getting a high valuation, and they continue to do well. But let's look at the growth rate in the three companies. Right, we've got CrowdStrike, and then we've got Palo Alto, and let's see what their revenue growth rates look like, and see which one is better from a growth perspective. So these guys are growing about the same rate as Zscaler. They are bigger, I believe. See, they're growing about the same rate from a percentage perspective. CrowdStrike's 3.7 billion. These guys are 2.3 billion. So CrowdStrike is bigger, but they're not like 10 times bigger. They're just a little bit bigger. And then our friends at Palo Alto, these guys are growing at a lower percentage rate, but they are bigger at 8.2 billion. So Zscaler is right there. I think I'm seeing a lot of value there. I'm seeing that, hey, these guys are getting it done. They're growing their business. It's an attractive software company. And if you look at their peers are doing well. Their stocks are really appreciating, but their growth rates are not. Like in the Palo Alto example, I can understand that their growth percentage rate is lower because it's a bigger number. So that makes sense. So anyway, so those are my comments there, Mike. I think it's a pretty good stock to take a look at. I'm going to put it on my watch list, and I'll take a closer look at that a little later. All right. So thanks for asking, Mike, on that one. Yeah, I appreciate the comment, Mike, and let's go make some money. Let's go make some money on software companies. All right, so we've got, make sure I don't miss any. Okay, so we went over Zscaler. And then we've got, could you please take a look at GMAB? Man, it must be a morning when I wake up and I'm not like as clear headed as typical because I've never heard of GMAB. So let's take a look at that one and we'll go through that. All right. So GMAB. So GMAB. Genmab AS develops antibody therapeutics for the treatment of cancer and other diseases, primarily in Denmark. Okay. So these guys are a healthcare biotech company. And I think on Monday's live stream, as well as other videos, I've talked about how small cap biotech and pharma, high growth pharma companies have been doing really well. Catalyst Pharma is one of the stocks that I own, and United Therapeutics is another stock that I own. When I ran a stock screener on Saturday in the community investor workshop, it revealed that the stocks that had the best fundamentals were in biotech and high growth pharma. And one of the other community members recommended symbol LNTH, which is right in this particular industry. So out of the gate, good industry. And I'll tell you why. As we go look at this company, the market cap is 12.76 billion. It sounds that, I'm in the US, so this would be an investment in Europe. That's a positive. I don't have a lot of investments in Europe, and there's a lot of good companies out there. So 12.76 billion in revenue. Excuse me, market cap, 12.76 billion in market cap. Revenue is almost 3 billion. The PE ratio is really good at 18.15, 22.67 in the next year. Analysts think it's really discounted, 105% discount. Over the past year, it's down 32%. Okay, it's down 32%. Analysts like it. Growing. Company is growing. They had a bad year here in 2021. I'd be curious to find out what happened. Did COVID restrictions shut them down? What was the deal? Also, understanding what their fiscal year is important. Sometimes companies have these weird fiscal years where the year ends like in the middle of the year, at the beginning of the year, at the end of the year calendar, and it kind of throws off our analysis because the months, right? So for now, I'm going to continue on. It looks like they grew really fast and they continue to grow. I like looking at the quarterly just to make sure the last quarter also looked good. And the Q3 looked good, 17.5. Okay, looks good. Now let's take a look at their margins and their free cash flow. So, holy smokes, 96% gross margins. Wow, that's incredible. And they were at 100%, meaning that they didn't have manufacturing capabilities. They weren't producing products. They were probably just licensing a patent that they achieved. They were able to go through the whole clinical trials, development of a drug, and they were able to get a drug commercially viable. And then other companies, bigger pharma companies, were able to pay them a license fee and then go make that drug. So that's what made them super profitable. Not bad. Not bad at all, man. It's like printing money. I think it costs more money to print money. So these guys are doing great. Free cash flow looks stupendous. So, and am I looking at the right currency here? Okay, DKK. So this is a DKK currency that is... So we got 0.14 to 1 USD. Okay, so when we look at their market cap, this is in US dollars. Okay. But when we look at their financials, understandably, since they are in Denmark, we're going to look at the Danish currency. And their free cash flow using Danish currency for the trailing 12 months is 6.5 billion. So 6.5 billion. And what I'll do is just do a quick calculation. So it's about 919, call it $920 million of free cash flow in the trailing 12 months. It's very good. They're growing at a really nice rate. It's been a little inconsistent, but maybe now the ups and downs are a little more understandable to me, meaning that maybe some of their partners, like a big pharmaceutical company, produced enough to put into inventory, and then they're like, hey, we're not going to produce anymore, because in manufacturing, you want to have efficiency and you want to turn on the factory, produce, and then turn it off. You don't want to run your factory at less than 100% of its capacity to achieve good efficiencies in the factory. So that kind of makes sense in my mind why they've had some of these ups and downs. So the cash flow looks good. It's 920 million. It's growing nicely. So this stock looks good. You're producing, if you multiply it based on their growth rate, right? You have a nice growth rate. Multiply that free cash flow times 20, you get up to 18.5 billion in market cap value. And that's being a little conservative because this is a good growth company. And maybe they get acquired by one of these pharmaceutical companies. It's like, man, these guys have really good drug patents that could be, acquired, and then we don't have to pay it. And then we can license it to other companies and so forth. So this is a really attractive stock. Now, what's been interesting is the healthcare space has just been getting hammered, but some of these stocks still do really, really well. And this one here first, I think it's really good. Let's take a look at their balance sheet just to make sure these guys have a good balance sheet. They have good EBITDA at 1 billion. And what currency are we dealing with? So this is, I think it's USD. Okay, very good. So 1 billion. And they have very little debt, 147 million, but they have $2.6 billion of cash. Yeah, this is a good stock. This is a good company. The space in healthcare, as I look at, general areas of opportunity, healthcare is at the top. I think we're going to get into CVS and Humana and United Healthcare, excuse me, Elevance, probably after I get done answering questions. But this is a space that's going to come back. Healthcare, these drugs, right? If you're unfortunately a person that needs this particular treatment, you're going to pay. You're going to take your savings and pay for those drugs. This company deserves that money because they took the risk of putting the investment into the science. The science could have not worked out, and the company lost all their money. So when they do achieve that, hey, they have a drug that really works, they deserve to be compensated in the form of profits. That way, the next company says, hey, let's go invest and try to, find cures to diseases to help people. Because if it works, then we will be rewarded. If you don't have that reward system, the drug discovery model breaks down, and then nobody takes a chance. Next thing you know, people are dying from diseases because the drug companies don't want to take chances. So that's my feeling on it. I know it could be a pretty emotional football that some people would view it. But that's how I see it. I worked at a pharmaceutical company. I understand the investment that goes into making a new drug. I participated in that whole process of starting with a new idea and going through all the hoops that the FDA in the US, and there's an equivalent government entity in Europe that forces you to make sure that that drug is going to be safe, make sure that drug is going to work for people. You're just not giving them, sugar water and telling them it's going to help them. So all those things, when you add up the amount of investment and risk that a company has to invest, it's humongous. So my feeling is we need to continue the reward system to continue the advancement in healthcare. And I'm a believer in that. So good one. You learn something new every day. And I am a little bit overloaded on biotech companies right now. Not a bad place to be. This would be a really good idea for an investment for me. But I also need to, keep an eye on how many stocks am I going to buy in healthcare. So I have a couple good ones. Catalyst Pharma is doing great. I'm up 48% on that stock. United Therapeutics is doing great, up 25%. Pfizer is beginning to pick itself up. I really am bullish on Pfizer. I'm buying more into Pfizer. I'm buying more into United Therapeutics. So the reason why I say that is I think this is a really neat idea, but I need to watch that I don't buy too many companies too fast. I am going to put these guys on my watch list and keep an eye on them. I do like that they're in Europe and I'm in the US. Not bad to be diversified around the world. So thanks for bringing this one up. I appreciate it. All right. So let's take a look at where we're at with the comments. And Mickey, thanks for joining. So is the PE for the Russell getting expensive? The answer is yes. Now, that's in the context of a very expensive market, right? We got the NASDAQ is on fire. It's up 35% in 1 year. So yes, the Russell is been doing well, but it's only up 17%. Is it getting expensive? Yes, but the advantage in the Russell is that there's more companies to pick from. When you look at the best companies or the S&P or even the NASDAQ, a good part of the value is near the top. The top 10 stocks are like 30, 40% of the value of that index, which gives us more opportunities to go find companies that are misunderstood. We just saw one in biotech that's growing really well, producing cash flows, and I think is an attractive company to research. We looked at Zscaler, ditto. It's beaten down. I don't know why. The company's growing. So I think that, yes, the PEs are increasing, but the Russell, with so many companies being a part of it, it doesn't mean that everything is overpriced. We just went over 2 companies that I think were reasonably priced. If anything, they're discounted. So that's how it give you a response to that. I appreciate the question. It's a good one. We're in an expensive market. It's reality. I continue to hold my stocks and I continue to buy carefully into stocks that I believe in, and maybe stocks that I just need to be an owner in, like Amazon. Good question. Thank you. Man, I don't even know how to pronounce your handle. I appreciate it. Rotel cheese. I've already butchered that. Sorry. Thoughts on Elevance versus United Healthcare. Man, you're going right down the road that I'm going, buddy. You see these symbols up here? That's where I was going. That's where I'm headed. Stick around. We're going to talk about that. So let's see if what you're seeing is what I'm seeing. I appreciate you joining. What's up, Android PC Gameplay? Good to see you. Thanks for joining. You know, Elevance and United Healthcare are beaten down. Now, I'm going to get into that, Mike. I'm going to share with you what my senses are in that space. It's going to be a little bit more qualitative because within the healthcare insurance payer space, man, where do I start? Give me a minute. We're going to get right into that. Let me just catch up on comments and then we're going to get into it. So AstraZeneca, man, I haven't looked at AstraZeneca in a while. This is a British company. And we'll take a look at that. Let me get into a string of healthcare payers. So the first one is going to be Humana. Now, Humana was just getting destroyed yesterday, and it's down 12.5% over the last month. It's down substantially over last year. And healthcare insurance payers, this is what we buy here in the U.S., and I'm not sure how other countries do it, but in the U.S., we have private healthcare as well as, to some extent, government-run healthcare. But it's always kind of a combo, right? Even if you do Medicare, which is what people receive once they get to, I believe, 65 years of age, then you get paired up with an insurance company that manages the whole process of you going to the doctor and getting that doctor paid and so forth, and telling you what your benefits are under the Medicare plan. You could also buy additional benefits in a Medicare Plus plan. For citizens under the age of 65, you buy healthcare through your employer or you buy healthcare as an individual. Humana and is with its subs provides medical insurance in the U.S. So they have this supplemental plan. I believe they do quite well with Medicare, right? So this is supplemental plans that, you know, we as citizens already qualify. If you paid into the system, you qualify for Medicare, and then you can get this supplemental insurance. So you say, hey, this is my base coverage, but then I want to have more coverage so I can get better health care. And that's where Humana operates. It's a big outfit, 67,000 employees. Now, you see a stock that's going down 47%, and you think to yourself, boy, their revenue must be crashing and burning. We'll see how that looks. $28.67 billion in market cap. It's a huge company, 115 billion. PE this year is 21. Next year, it's going to drop to 14.8. Analysts think it's a hold, but it's discounted. So when we look at revenue growth, the stock is down 50%, just using round numbers. Revenue's up 12%. Those are two opposite trends. You have the stock is being sold off. Humana has been an undesirable stock to the market. It's been an unpopular stock. It's being sold off. But they just keep growing their business. So they keep growing their business, and it's already a gigantic business, $115 billion of revenues. That 12% of growth on 115 billion, that's well over $10 billion of revenue growth. So to me, that's really impressive. A big green flag. So they sell a lot of revenue. What's their margin? Do they have a very good profit margin? Maybe that's where we got problems. We're going to compare this to United Healthcare, Elevance, which are, I think, good compares. Not perfect, but good. The profit margin is low. And maybe this is why the market is saying, hey, I don't like Humana because look at this margin. 1.18%. Historically, it was at 3, 4, 4, 3, 4. So we're seeing a trend where they're getting squeezed. And that's not a lot of margin. This really is concerning to me. I just talked about a software company that had margins up near 80%. It was like high 70s. We looked at a biotech company that had 96% margins, and now we're looking at 1% margins. It's a very undesirable gross profit margin. They are not producing free cash flow, so they're really getting squeezed. So the 50% sell-off in Humana is understandable. It's not that, hey, people just don't like their logo, they should pick a different color for their logo. No, there's some fundamentals that are showing there's something broken in this business and it needs to be repaired. Now let's take a look at the quarterly and see if maybe the quarterly is showing that, hey, they realize that something was broken and they're beginning to fix it. Let's take a look. And hopefully, nope. Profit margin for the quarter, 1.6%. Free cash flow is positive. That's good. And they had a really tough fourth quarter in 2023. I mean, everything was like not working. This profit margin really concerns me. So let's kind of keep this in mind. So we have low margins. That's a giant red flag for me. Let's take a look at the balance sheet. How much debt are these guys carrying? So we have EBITDA of 3.69. Okay. We have debt of 13 billion. So they are carrying a lot of debt. Wait, cash 24 billion, debt 13 billion. Okay, so they're doing fine. Their balance sheet's fine because they're carrying more cash than they do debt. Okay, very good. So not worried about their balance sheet. They got plenty of cash. Let's take a look at United Healthcare. Compare their metrics over to Humana in a bit. We'll look at United, we'll look at Elevance and see what they're looking like. So United Healthcare, I was a stockholder for multiple years. I did really well at the stock. It was a very well-run company. You look at this upward chart, very beautiful. But if you see from here to where they are now, you'd actually be losing money if you're a holder of the stock for the last 2 years. And a big part of it is that, really, really bad situation with the CEO getting assassinated. It's just a horrible, horrible story. I'm a father of 2, and to think about a dad, getting assassinated and being taken from his kids, I think about those kids whose lives have been, really changed, as well as his wife and everybody else that was in his immediate family and community. So just terrible story. I think United Healthcare is a very well-run company. And I know that there's a lot of tension between the public and some people, I would say, in the public, maybe that had a very bad experience with health insurance companies. I can understand that being super frustrating when somebody's sick and you care about them, or you yourself are really sick and you get frustrated. So they've really, the healthcare system, that's getting back, Mike, to, are these companies discounted in just a fabulous opportunity? This particular industry to me is, man, there's just too much radiation. There's just too much there that is like, what's going to happen? I think the public opinion of insurance payers is really low. The trust is not there. Politicians are attacking insurance companies. They're just hammering them. It's kind of like the convenient villain in the story. And I think that's going to continue to put stress on their industry. Their margins are going to be squeezed. The industry is going to be squeezed. So that would be one thing that's a giant red flag for me is, okay, this industry is either to it's either their fault or just bad luck or however it happened, they're in a bad situation. So let's continue on, look at the fundamentals, but we will return to that kind of storyline. This is a massive cap company, 459 billion in market cap, 393 billion in revenue. PE of 32 now. In the future, it'll be 17. Strong buy. I don't know. I think there's more outflows than inflows, but that's what analysts said, and it's discounted by 23%. When you look at this company, it's a massive company. Total revenue is almost 400 billion, and they're growing at 9%. Holy smokes, that's big growth. When you look at that type of growth, it's like they're growing 3.6 billion per year. It's massive. So good job on the growth. Profit margin. See, their profit margins are really collapsing. Look at that. We saw this with Humana. Going from 6 to 3 is that's a collapse, right? And if this continues, the fundamentals are following the general story that these guys are getting squeezed. There is public opinion that, hey, government, federal government, senators, congressmen and women, go do something about it. So they may take it on and start squeezing these insurance companies and putting more cost on them and reducing their revenues and profits. You're seeing the fundamentals change. So that's really catching my attention that, hey, am I seeing the beginning of something that's going to be bad for United Healthcare? We saw it was bad for Humana. So Humana was at 1.5% gross margin or so. And this one's at 3.6, but it's been dropping. Okay, this is not good. This is bad. So I would be watching that. That tells me kind of what I need to know on United Healthcare. I was a stockholder. I sold my stock. I have a lot of respect for United Healthcare. I am a United Healthcare customer. My family has been on United Healthcare for a long time. And I would tell you that we are happy customers using their insurance. Has every experience been perfect? No. Generally, in the time that I've had United Healthcare, I've had my younger son was born, very happy with how they covered us. We've had a couple of situations that needed healthcare, very happy with how they treated us. A couple frustrating moments, but let's face it, even my favorite restaurant screws up once in a while. So not every situation is perfect. All right. So these guys, their balance sheet should be strong. Their total debt is going to be about 45 billion, but their EBITDA number is 35 billion. They can pay off debt in a little over a year. And overall, I think if we look at their free cash flow, their cash flows, let's see how that's doing. It's been a while since I've looked at United Healthcare. See, this cash flow is dropping. So they're getting squeezed. If I look at this cash flow, the perception of the industry, I think the company is worth around 200 billion, and it's well north of 200 billion. So I am a seller of United Healthcare. I already sold it. I sold it a couple years ago. I continue to sell United Healthcare. They just became really expensive stock. Now we're seeing their fundamentals really change. And those fundamentals, it's going to be hard to get those margins back up. I switched horses back in the day and bought into Elevance, but I have sold out of Elevance in 2024. Let's take a look at their fundamentals. Elevance is somewhat of a smaller United Healthcare. They do very similar. They compete against United Healthcare. They're just a much smaller cap company. And the revenue is really good. It's really high. PE is really low. Forward PE is really low. really discounted according to analysts. I mean, look at all these metrics. Looks good. When we look at their revenue growth, the revenue has been slowing down. And yep. Now they had a very bad Q2, and their stock price has not been doing well, by the way. Down 20% for the year, but look at from September to now, that's really where we've seen just a big drop, maybe 25-30% in their stock price. So let's take a look at that gross margin number. What's going on with gross margin? So these guys are holding their margins, okay? Much better than United Healthcare. They had their margins really nice, but you saw their valuation was really high at nearly 500 billion in market cap. These guys, you can see operationally, these guys are not screwing up. From a free cash flow perspective, their cash flow is also going down. So we just saw 3 companies, health insurance companies, that cash flows have been vaporized. So having said that, I'm going to be very careful in not overbuying into health insurance payers. Elevance, United Healthcare, Humana, and even CVS that has a health insurance payer component to it. They're more diversified, and I think that's a good thing for CVS. But you can see that Elevance, as well as United Healthcare and Humana, there's something here that has to be figured out for this industry. You know, as an investment, I mean, Elevance, out of the 3 we just saw, Elevance, United Healthcare, Humana, Elevance is the one that I would pick. I just showed you fundamentals that show that the company is not as not their performance is the best of the 3. If you look at gross profit, their cash flow looks good. I believe they're discounted. If you look at fundamentals, the revenue is good. I think the one that's overpriced is United Healthcare, and then Humana is kind of a wild card. If they figure it out, I think that stock could really, really go up because it's so discounted. But that's the art of investing, is we have to be good at math, be good at science, I guess. But we also have to like put a lot of qualitative information together and say, this is what I think is going to happen. And it makes it really fun. This space here, just I'm being super careful with it because it's just been really underperforming. And I don't know that we're seeing the light at the end of the tunnel all that close. We may be in for another year of pain and suffering within this space. So those are my comments. I think a few people are interested in these stocks, and hopefully you found my information interesting. So good luck out there. So the next stock I'll try to hit is AstraZeneca, but let me catch up with so Omar, what are top stocks to buy? Well, that's a big question. And rather than, giving you answers to that, just follow along. And I think we covered a couple that were pretty good ideas. One was a software security company, and the other one was a biotech company. Selling Citi or Hood? Nope. I am buying more Citi. I'm holding my Robinhood. Robinhood's been a super winner. Go Robinhood. BWLP, that's come up a couple of times, and they look really solid from a fundamental perspective. It's just, what's that industry going to do? Is the market going to buy into that industry? Oscar Health. Never heard of Oscar Health. So these guys, very small cap. So this is a small cap play into health insurance. And they are 3.5 billion in market cap. Revenue is really good. P is really high. They are growing really nicely. Okay. And when we look at their financials, they're growing at a 51% clip. Part of it's probably because they're small, but it's still 51%. Great job. Their profit margins scare me. They are profitable. Excuse me. They do have positive margins, but we just saw evidence that the big health insurance payers are being squeezed, and you're seeing their margins drop. Is that going to catch up with this small company? That would be one of the main questions I would have there. Their growth looks really good. I would say that. Free cash flow has gone positive. Looks great. Looks really good. These guys, when they came out and IPO'd a couple years ago, they were flying high, up 80%. Wow. Looks interesting. This may be an interesting stock to track. I think the best is yet to come for them. They've achieved positive gross margins. Their free cash flow is positive. They have high growth rate. This one's looking pretty interesting. I think I'm going to take a closer look at it. Yeah, thanks for bringing it up. This is kind of a new idea within the healthcare insurance space that maybe is worth taking a look at. Yeah, good one. Thanks. So Mike, not buying into BWLP. You're just holding. Very good. Okay, cool. Cool. Elf. So let's take a look at Elf. All right, let's take a look at Elf, and then we're going to end with AstraZeneca. So Elf Beauty. Speaking of industries that I have very little knowledge on, is beauty. So they do cosmetics, skincare, and so forth. Very good. And over the last year, it's down a little bit. It was really high, and it's really come down. It's up 11% over the last month. It's a $7.6 billion market cap company, $1,222 million in revenue, really high PE, and the forward PE is also very high. It's a strong buy according to analysts. It is growing very nicely, 59% growth. And the latest quarter is a little bit lower, but those quarters just keep getting bigger, right? The numbers are pretty big. Sequentially, there is a little bit of concern there that sequentially you see how the revenue has dropped. That could be a sign that revenue is really slowing down. So that is one red flag, but there is a green flag that, hey, they've been growing nicely. They're a little bit of they're a smaller company, right? But the growth rate's nice. What are the margins on? Look at those margins. Beautiful. 71%. And they've expanded their margins. So they've become better at, producing their product. Very good. Free cash flow is 22 billion, not very high. And it's been a little bit all over the place, like 49, 34, 23, 14, 10, 100. So it's hard to see a projection. Like we saw that software company, Zscaler. You notice that had a really nice shape to it. The data showed that, hey, they just keep growing. That obviously you have more confidence in that type of trend. Here, it's like, what's going to be next? 100, 50, 0? I don't know. It's hard. So this one here doesn't give me a very good basis to do a trend and a forecast. So these guys are 7 billion. Um, I don't think the free cash flow is going to give me a valuation near 7 billion. I'd probably be around 2 to 3 billion. When I look at their forecast, some analysts think it's going to do great. Some analysts think it's going to be okay. And some analysts, not too much downside. So the revenue is supposed to grow nicely, continue to grow real nice, slow down a bit, but it's going to grow nicely. And so is earnings per share. The PE is fairly high. I'm going to disqualify myself as saying, hey, this is a space that I really know. No, it's the opposite. I really don't know beauty. Just the fundamentals to me, I'm seeing more red flags than green. I would not be buying into ELF. But if you know this industry better and you know that, hey, these guys are doing something that's really unique and better, that might be the basis of making an investment in this. But just high level, I'm not a buyer into ELF. That free cash flow concerns me. You're not having consistent cash flows, and that's a majority of my evaluation. I like to see consistent cash flows. This is concerning to me. It's like, what's going to happen next? So that's ELF. AstraZeneca. So these guys, this is a pretty big outfit, 207 billion biopharmaceutical company. I believe they're in the UK. They've got some really good drugs. 51 billion in revenue. PE is a little high, but next year it's going to be really good. It's a buy, according to analysts, 34% discount. Look at this growth. Beautiful. This is a big outfit. They keep growing nicely. They had a low point in 2023, but they're growing nicely. Look at that quarter. Wow. Very good. If we look at the year, wow, revenue is going up while the stock is coming down. I see an opportunity. See, the stock was doing great up until August of 24, and then the bottom fell out of it. And there's probably a story out there that explains that. Fraud and corruption. Fraud and corruption. Well, it'd be important to understand that and see if it's just a lot of smoke without a fire or what's going on with those allegations. But the stock is being beaten down. The fundamentals look very good. And pharmaceutical companies tend to have very good margins, 82%. Beautiful. That's a great margin rate. Free cash flow. This is what I'm looking for. You could expect that their margins are going to be that good. This stock's discounted. I agree with that. You got to qualitatively, you got to look at those stories of fraud and so forth and see, is there a lot of facts there that are concerning, or is it just one more complaint against a pharmaceutical company? Pharmaceutical companies, they're easy to, criticize. They make a lot of money, and it seems when you have a drug that really works and they make lots of money on it, they're like, oh, you see, they're really, really greedy. But of course, the journalists don't disclose is, oh yeah, there's one successful drug, but let's talk about the 20 that were unsuccessful and they lost a lot of money on those. No, let's not talk about those. I think that would be a fair representation of the industry that, hey, these guys are taking a lot of risks. It's not just all, gravy for them. They're taking risks. And if they stop taking risk and stop doing drug discovery, they will be replaced. That's what's awesome about free markets is if you're idle, if you stand still, you will be passed by your competitors. So AstraZeneca, Pfizer, and all these, Eli Lilly being the star of the show, they continue to discover new drugs that are going to help people. And that's awesome. That's great. Mankind wins. We get better drugs. We get to live longer. We get better quality of life. They win because they have good profits. Everybody wins. And that's my observation of the space. That's my opinion on it. All right. So this one looks interesting. Looks really interesting. I think I'm going to take a closer look. And maybe it's worth following, getting my head around these allegations that they're faced with, and maybe worth investing in it. So we will see. All right, everybody. I think that's a good point to wrap it up. I like speaking of industries I hate. Yeah. Anyway, so good comment there. Everybody, thanks for tuning in. Let's see what the market's doing before we call it a wrap. So we're kind of like where we started. The Dow's up 0.3, S&P, NASDAQ, and so forth. We'll see how we play out the rest of 2024 and what 2025 has in store for us. Let's take a look at that economic data and see what we're going to be faced with. I think there's always discounted stocks, no matter what market we're in. It just gets a little harder. And I think it is harder right now to find some discounted stocks. I think we're tapping into potentially a good space, which is biotech, high growth pharma. It looks pretty good. I think we'll see how those big health insurance companies, get themselves out of that mess. And then Zscaler looked pretty good as a software company. So I'm going to take a closer look at that one. Thanks for suggesting it, Mike. So everybody have a terrific Wednesday. Good luck with your stocks today. Really appreciate you tuning in. And remember, all stocks that I talk about, it's just an opinion from one guy, one investor. It's not financial advice. I'm not recommending you buy, hold, or sell anything that I talk about. Do your own due diligence, make your own decisions on that. Thank you for watching. Take care.